Welcome to the last unit of Accounting 3370, Property Dispositions. In the prior unit, we considered how you would record the value of an asset, or the taxable basis, upon acquisition. We considered the depreciation or amortization process for the asset. And in this unit, we're going to look at how you calculate the gain or loss that's recognized on sale or disposition of an asset. There's three factors that come into play when computing the gain or loss that you recognize on your income statement and on your taxable income when you get rid of an asset. How much gain or loss are you realizing? When is the gain or loss recognized? In which fiscal year? And does the tax code specify how to treat the gain or loss? So we're going to look at each of those questions. We know from our prior studies that the tax code doesn't report a gain or a loss until a transaction occurs that necessitates reporting that gain or loss. And what do I mean by that? Let's think about our stocks. Throughout the lifetime of holding a specific stock, the stock value may increase or decrease or do nothing or bounce around as though it were a ping pong ball. Until we write off the asset or sell it, we keep the asset on our balance sheet at the amount that we paid for it, or a taxable basis. When we sell it, that's when we would recognize a gain from the sale or a loss from the sale. We compute that gain or loss using the following formula. First, you calculate the realized amount of sale, which is the cash, the property received, the reduction in the loan balances, minus any selling expenses, to reach the selling price. You subtract from that the basis of the property to the property holder, and we computed the basis as well as the reductions in basis through capitalization in the previous chapter. What you get from that formula is your gain or loss. A gain occurs when the amount that you realize on sale exceeds the taxable basis, and a loss occurs when the amount that you realize on the sale is less than the taxable basis. So let's check your comprehension. What would be the gain or loss on sale if Sugarista LLC owned industrial kitchen equipment with a $12,500 initial cost basis? The accumulated depreciation for book purposes is $10,000, and the accumulated depreciation for tax purposes is $11,500. She sells the equipment for $2,500, and her business, as an incorporated business, pays 21% taxes on any proceeds received. So let's look first at the book purposes, the amount realized per the books. She sells the assets have a value of $12,500, and they have a book depreciation of $10,000. Which means that the carrying price of the asset is $2,500. If she sells the equipment for $2,500 and the equipment has a basis of $2,500, her gain or loss is zero. She's selling the assets for exactly what they're worth on her financial statements. But let's look at it from tax purposes. What is her tax gain or loss? For tax purposes, she's recorded $11,500 in depreciation costs, making the equipment worth exactly $1,000. If she sells it for $2,500, she has a taxable gain of $1,500. And she would pay 21% tax on the gain on that sale. Which means that Sugarista's after-tax cash flow would be $315, meaning that she would owe $315 to the IRS for the profit that she made upon the sale of the equipment. Now let's look at a different situation. Let's assume that Sugarista, instead of selling the property for $2,500, sold the equipment for $500, and the purchaser assumes the remainder of the $3,000 business loan that she took out to purchase the equipment. What would be the amount that Sugarista realized on the sale? As we talked about, the amount realized can be cash, it can be an exchange of equipment and valuable services reported at their fair market value, or it can also be the assumption of debt. Because in each case, this represents a sale or a benefit to the seller. So, in this situation, Sugarista is receiving $500 in cash, and they're assuming the $3,000 business loan, which means that the amount realized on the sale is $3,500. Not bad. Sugarista's after-tax flow from the sale, if she's selling the equipment, if the equipment has a value for tax purposes of $1,000, she's recording a gain of $2,500. If she pays 21% tax on the sale, she would then owe the IRS $525 on the gain that she recognized upon selling her equipment. So a taxpayer only pays taxes on gains. Any amount above the initial value of their investment is taxable. They are not taxed on the initial value of their investment. This is just a recouping of assets. A seller does not pay taxes on the loss. A loss on sale or exchange is entirely a tax-free recovery of their investments. The tax treatment of a gain or loss depends whether it is a capital gain or loss or an ordinary gain or loss. A capital gain or loss is generated when the asset surrendered is a capital asset and the transaction triggering the gain or loss is a sale or exchange. An ordinary gain or loss is anything other than a capital loss or a capital gain. So what is a capital asset? A capital asset is any asset that is not inventory or property held for sale, accounts or notes receivables generated through ordinary sales in business, supplies, real or depreciable property used in a business, patent, invention, model, design, secret formula processes, and other intangible assets. U.S. government publications, commodities, derivative financial instruments held by a dealer, and hedging transaction properties. Basically, capital assets are benefits that are intended to generate a profit in the future, but a profit exceeding that would be generated through ordinary business processes. So let's look at the facts. Is it an ordinary gain or is it a capital gain? If an investor purchased a 50-acre tract of farmland northwest of Washington, D.C., that was purchased for $4.68 million, and then the investor sold the land for $10 million, how would you characterize the gain in each of the following scenarios? First, if the corporation that acquired the land in the first place added roads and utilities before subdividing the land into parcels, the land sale with the improvements was to a developer. Is it capital or is it an ordinary gain? The IRS would consider this an ordinary gain because of what the original purchaser did with the investments. It's clear that they purchased the land in the course and scope of business improvements, and real estate development. In this case, any gains made on the sale would be treated as ordinary income. In the second scenario, how would you characterize the $5.32 million gain if the corporation made no improvements to the land and sold the land directly to another investor? In this case, it would be considered a capital gain because of the nature of the transaction. Think about stocks, which are the most frequently thought of capital assets. You purchase them at a given price, you hold them for an extended period of time, you don't do anything with them during that time period, and then you sell them, ideally at a higher price, in the future. This is what the investor did when they purchased this tract of land northwest of Washington, D.C. They purchased the asset, they held it, they made no improvements to it, and they sold it later once it had appreciated in value. In this case, the gain would be a capital gain and would be taxed at the capital rates. So let's look at another case. Baker's Dozen is the name of an oil painting by Cal Ortiz. Let's determine whether the gain on the property is ordinary or capital in nature, and if so, what the amount of the gain or loss reported would be. If, in the first scenario, Ortiz is the taxpayer, he sells the painting to a local gallery for $6,000. Is it capital or ordinary is the first question. The answer is ordinary because Ortiz is the artist. Any works of art or amortizable assets like copyrights, patents that are generated by the artist are excluded from the description of a capital asset. Therefore, Ortiz's basis is 0 and his gain on the sale is $6,000. Let's look at the second scenario. The taxpayer is the local gallery who sold the $6,000 painting to a local buyer for $10,000. Is it a capital gain or is it an ordinary gain? In this case, it's an ordinary gain because a local gallery is routinely in the process of acquiring paintings, of holding them as inventory, and as reselling them. Their gain is $10,000 that they realized on the sale, minus the $6,000 that they paid to acquire the asset from Ortiz. Therefore, their ordinary gain is $4,000. Now let's look at this Third scenario, the local buyer who purchases the painting from the gallery is Georgetown Cupcake, a confectionery made famous by a TLC show called DC Cupcake. Georgetown Cupcake displayed the painting in its flagship store until it sold for $45,000 to a collector. So in the first case, is it a capital gain or is it an ordinary gain? In this case, it's a capital gain. Georgetown Cupcake's routine and ordinary business is selling cupcakes, and delicious ones at that. They don't routinely acquire art and sell art, but in this case, they acquired the artwork, held it until it depreciated in value, and then resold it. So in this case, it's a capital asset. Their gain on the purchase, assuming they're the buyer who bought it for $10,000, is $35,000. The excess of the selling price minus the acquisition price, or the basis. This makes a difference because of the treatment of capital losses and ordinary losses. Ordinary gains and losses are simply included in one's income and taxed at the regular rate. But capital losses can only be deducted to the extent of capital gains. The treatment of capital gains varies based on whether you're an individual or a corporation. For an individual, you can deduct $3,000 in the year that you incurred a capital loss. Any additional losses can be carried forward indefinitely to offset future capital gains. Corporations don't get to deduct any portion of a capital loss, but they can use it to offset capital gains. They can carry these losses forward for 5 years to offset future capital gains. Corporations can also carry a capital gain back for 3 years, which would then generate a refund of taxes paid. Individuals don't have that opportunity. Capital gains for a corporation are included as corporate income and are taxed at the regular corporate rate of 21%. Individuals, as we talked about in Module 2, get a preferential rate for capital gains ranging from 0% to 28%. So finally, let's check your comprehension. How much income would you record if Sugarista recorded $100,000 ordinary income from its custom cookie delivery business? It also sold 3 non-inventory assets during the year. What would be Sugarista's taxable income if Sugarista is incorporated and the 3 items sell at a $45,000 capital gain, a $12,000 capital loss, and a $19,000 capital loss? In this case, Sugarista's net capital losses are $31,000, and her net capital gain is $45,000. She would record the additional $14,000 as a capital gain. If in the future she suffered a capital loss, she could use this to offset the gain. Situation number 2, if Sugarista is incorporated, suffers a $17,000 ordinary gain, a $22,300 capital gain, and a $58,000 capital loss, what would be the effect on her income? The $17,000 ordinary gain is taxed as ordinary income, and it's taxed at the 21% rate. The capital loss of $58,000 offsets the capital gain of $22,300 for a net capital loss of $35,700. Unfortunately, Sugarista can't, as an incorporated business, can't do anything with the $35,700 loss. She just has to hold on to it until she recognizes a capital gain in the future. And in the third situation, same situation, except Sugarista is a proprietorship. What would be her taxable income? She still pays ordinary tax on this $17,000, and she's still on the hook for this net loss of $35,700. However, as an individual taxpayer, she can deduct $3,000 on this year's return and hold the remainder for future years. That means her tax effect is a loss that carries forward with a value of $32,700. And this $3,000 can be used to offset this gain. The tax code also makes a number of provisions for the disposition of non-capital assets. The tax treatment of this disposition varies based upon whether the firm uses accrual basis accounting or cash basis accounting. Two in particular are inventory and land. The sale of inventory is treated as ordinary income or loss. The sale of land can either be treated as a capital asset if it's held for investment purposes, or an inventory item if it's part of ordinary operations. Business accounts receivable have a tax basis of their face value if the firm uses accrual accounting, and a face value of 0 if the firm uses cash basis accounting. The gain realized is whatever the accounts receivable are sold at. On the cash basis, any ordinary income received is the realized basis. Business supplies are the same thing. While they're generally deducted as used or deducted at year end, if they're sold for other purposes, the selling price is the amount realized. For an accrual basis firm, their value on the balance sheet is the amount of their basis. For a cash basis firm, the taxable basis is 0. In this class, we've gone over the vocabulary and the terminology used in federal taxation, the tax enforcement process, and the philosophy behind the creation of tax rates. We've examined the individual tax process, as well as the income items and the deduction items that are allowed for individuals. In this final unit, we've examined certain business decisions that you'd need to know as an entrepreneur and their tax treatment so that you could report them on Schedule C as an individual. There's lots more to the tax code. The tax code is well over 1,500 pages long, and it changes frequently. But this course focused simply on individual taxpayers. There are more tax courses in McMurry's in-person curriculum, or if you elect to go into a tax MBA program or a Master's of Science Accounting program. I hope this class has given you a worthwhile exploration of individual taxation and a stronghold for whatever your future endeavor in business may be. Thanks for your attention, and it's been a pleasure.